Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Just amazing. It's just amazing. When I look around and I see what's happening, I'm flabbergasted. There is so much growth. There are so many things to do, so many things that need to be done, and you've got economies. Actually, you have multiple economies around the world trying to race each other to get these things done, and that's a good thing. That's a really good thing. I really fired up about it, actually. I think over the next 10 or 15 years, people will be pretty happy. I know stocks valuations are pretty high right now, except, outside of the United States, they're not nearly as high because those markets have not done nearly as well as the markets here have done over the past 5 and 10 years. At some point in time, that probably writes itself. So if you're holding on to some international stuff, I wouldn't worry too much about it. So one of these days, sooner or later, it should put in a big run and could pay off for you big time. But, having said that, I guess I should probably let everybody know here. I've been working on a couple of new models. They're not really super sophisticated. One of them is just the semiconductor and healthcare. You've probably heard me talk about that a lot. All the stocks that are in that particular model are in some of the other funds that we hold at Bullington Capital, and I think that's a kind of a good idea. I know it is. It's one of the reasons that the stock market's done so well. These two industry groups have been leaders in the overall markets, large, medium, small cap markets in the United States over the past, 10 or 15 years, going back a long time now. They are more volatile. And here's why I'm spending time talking about that. The first part of the show, I typically talk about economics. The second part, I'll talk about fixed indexed annuities. And the third part, I'll talk about individual stocks. So we're going to try to keep with that today. And instead of just basic economics, we're going to go into how that affects financial markets over time. Specifically, how are the healthcare and technology sectors, how are they going to do in coming up over the next 10 years? Will they do as well as they have in the last 10 years? I doubt that. The last 10 years have been awesome. I mean, really awesome. But you never know. And right now, they're not overpriced. That's what really encourages me about this. They're not overpriced. I've got a model that I cannot send out to the general public because the license that I have to the information, I'm not allowed to disperse it to the general public. But if you call or write, if I've talked to you on the phone, that means that we have now started a relationship. And the relationship allows me then to send you this information, and I can send you an email and you can see what I'm talking about. It's a big deal. And if somebody were offering me this free information, I would probably take it. But you do have to call, and I do have to speak with you personally because, again, I don't have a license to distribute the information to everyone. I literally have to have a relationship with the people I give this information to. So it's not hard. I mean, you don't have to have an account. That's not necessary. It would be nice if you were thinking about opening an account, and I can show you what I might be able to do for you. And this is one of the things that I do to try to differentiate myself from your traditional financial advisors. I love the stock market. I really do. It's challenging. It's a lot like the opposite sex, actually. They do a lot of things that we men just don't understand. And it's always going to be that way. And it's always been that way. And guess what? Yeah, that's okay. You learn. You learn to put up with some stuff. That's what happens. And you've got to be that way with stocks. I'm telling you, financial markets, they are not going to behave the exact way that you want them to. But if you figure out how to tolerate it, you can really benefit from it. Like the marriage. If you figure out how to tolerate it, and sometimes that's hard to do. That's really hard to do. So I know everybody that's married out there is going, yup. So anyway, the best things in life are actually not free. You're going to pay dearly for them. No, I'm just kidding. But with stocks, you have to put up with the fact that they're not going to behave like you'd like them to. You hear these stories about people who have made tons of money in stocks. Well, let me tell you something. They didn't make it overnight. They didn't make it in a short time period. Those people that made a lot of money in a short time period have a tendency to give it back. Okay. Normally, the big returns come after years of doing this. They come after a lot of fluctuation. Now, what gets hard about that, and by the way, I think there are lots of opportunities in the stock market. And if you want, I will also send you, if you call me up, go to my website, say, listen, Bill was talking about portfolios, and I'd like to see copies of the portfolios that he was mentioning. Okay. And that's all you got to do. Just put it in writing. And then and in that case, you don't even have to call. You don't even have to talk to me. But if you'd like to talk to me, that's fine. And I can send you this stuff out. I just have to have some interaction with you about money to be able to send this information out and not get in trouble. So anyway, I really like the tools that we have today are just mind-boggling. The database I have to do all this stuff with, all the research. Let me take a look at this. So I'm looking at the open-end funds. Those are the funds that, like traditional mutual funds. There are 24,796. Okay, 24,700. That's just mutual funds. Okay. Now, if you count offshore funds, those funds from all around the world, okay, there are 111,000. A lot of funds. But even the 24,796 funds is mind-boggling. Those are, again, that's just mutual funds. Let me go see. You've got variable annuity sub-accounts. Those are mutual funds too. There are 224,000 of those. 224,000 funds in variable annuities. That is crazy. Let's see, what is the exchange-traded funds? The exchange-traded funds are the babies of the group. They actually have more money than the other ones do. But it's 2,891 exchange-traded funds. Okay, there are only about 3,000 stocks that are big enough for you to invest in, that for a fund to be allowed to invest in. So you've got about 3,200 stocks that a fund would be allowed to invest in, and you've got tens of thousands of more than 50,000 funds looking at those same 3,000 stocks. Now, that does explain why stocks are so volatile. Okay, because these guys everybody's competitive. They're trying to beat everyone else, except for the exchange traded funds. Those are basically, the vast majority of them are run by a mathematical formula, and that's what I like to do. When I'm picking stocks, I like to have a checklist. Does the stock meet all the criteria on my checklist? Do they have sales? Yes. Do they have profits? Yes. What kind of return are they earning on the money that's been invested in that company? Those are the types of things in the long run that are going to matter the most. So I look at the funds that have that criteria in them, and I like to try to focus on the top 20% in each of their categories. And if I can do that, that's basically how I search for the funds that I have in the portfolios. I'm looking for things that I think make sense. You got to have sales. You've got to have earned or at least have some cash being generated. I don't like to invest in businesses that aren't generating any positive cash flow. You can generate cash before you're generating a profit, by the way. Most companies do, especially when they first come public. So anyway, it's so much easier, by the way, today to find those criteria in a fund. You've only got a few thousand funds to look through, by the way. One of the reasons I will always have a business. The other reason is it's tough. Even the funds. I mean, the funds fluctuate like crazy. The funds in the semiconductor industry, you should see how volatile they are. And so those big returns that they put up over the years have come at a cost, and the cost is they fluctuate more. Now, and this is what you have to pay attention to when you start getting closer to retirement. Yeah, everybody wants to make money. We all want to make money. We all want to make as much money as we possibly can. Okay, but most of us can't afford to take the risk of the stocks dropping 50% or more in our retirement, or when you're 5 years from retiring. I mean, who wants to do that? The S&P 500 dropped 50% from March of 2000 to March of 2003. You want to talk about Chinese water torture? That was 3 years. 3 years. And when it was all over, it was down a little over 50%. And then when it recovered in November of 2007, it turned and started going down again, and it went down 57%. So by March of 2009, when you're down 57% from where you were in March of 2000, okay, that does not feel good. You can't have that in your portfolio. Okay. And the reason I never talk to clients like this. I never raise my voice. I shouldn't say never. But it's extremely rare. And sometimes I just get a little carried away, I guess. But it's hard. I know a lot of people come in and they look at these funds and go, look, I want that return. Okay, let me show you how that return was achieved. And I don't have a problem with that, with you shooting for a specific return, but I want you to know what the risk involved is, because you can't do it without risk. My best performing account is the one that fluctuates the most. I promise you. The best performing account I have is the one that fluctuates the most. And next time we get going to a seminar, I'm going to break out the details and the formulas that I've been using for that. In fact, Mike Seeger publishes the most popular one. I'm using that about 95% of the time on the website Look Out for the Bull. And it's all math. It's all math. And you try to get the emotions out of it. See, one of the reasons you want to get the emotions out is because of what I was just saying. Stocks are so volatile that if you are highly emotional, you should probably not be doing individual stocks. You should probably, unless you can learn, because I'm telling you, I didn't have the mindset when I first started, and I believed everything a whole bunch of people said that wasn't true, and I learned the hard way. And experience, by the way, is a great teacher. I just wish it had been somebody else's experience I'd have been able to learn from instead of having to do it all myself, because that is rough. And by the way, if you're past the age of 40, your life expectancy is not long enough for you to learn everything you're going to need to learn. Well, you could if you decided to devote yourself to it for maybe 4 or 5 years. And when I say 4 or 5 years, I'm not kidding. Go look at the book. Get the book Accounting for Dummies. Okay, that's where you begin. When you're halfway through that book, if you're not if you haven't fallen asleep at least 4 times, it's because you're not trying hard enough. Just kidding. But it's boring. I mean, there's a lot of stuff. And you have to know this stuff so that you know if it ever comes up, you'll know what to do. And that's life in general these days. I am just flabbergasted. Just for kicks, I signed up for this beginner course on taxes. Okay, I got the book. The book is 2,200 pages, single spaced, the 10-point font. You know what that means? Like the writing's not that big. And it's 2,200 pages for the beginner. Anyway, listen to Bill Bullington right here on 1420. I'll be back after these messages. And we're back. I would be surprised. I have to thank everybody out there listening today. All three of you. Oh, that's a bad joke. But anyway, maybe some, there may be more than three people listening. But Christmas Day, it's a big holiday, huge holiday. And I hope you have a good one. Hope you stay safe. Hope this next year coming up for you is going to be a good one. And I think we've got an awful lot to be thankful for. I mean, when you think about it, things are really not that bad. And in some cases, they're really good. But if you're having a hard time, I feel bad for you. My heart goes out to you, and just want to wish everybody a happy holiday season. Hope everybody has a great upcoming new year, and we've got some things planned this year. It's pretty good. At my company, they've asked us to move across the street. The company that owns my building owns a bunch of buildings on the street that I'm on. They're all very nice. So we're going to be moving into new space. We're supposed to be there already, but so I have no idea when. I think it's supposed to be around March. But it's got a facility that will allow us to do some meetings there. I know there's an investment club, and these guys listen pretty often because they like the individual stocks, and we'll be able to do some meetings there. And they've got some other spaces there that we can do some slightly larger meetings and just kind of hang out and have fun. One of the great things about financial markets today is that a lot of the tools are not that expensive anymore. I mean, I can't tell you how much money I used to have to pay, which is really tough when you have 3 kids and you're trying to build a business. That's expensive on its own, and then you've got all these research and development costs. It was tough. And I wish I had had access to the tools that people have access to today. One of the best, and I don't get paid for this stuff, but Morningstar, I have a professional subscription to. That's where I have those models that I was talking about earlier, the healthcare and semiconductor in particular. You could add this to what you're doing. You could just do this. You could just open an account and say, yeah, I just want to do that. That's going to be really aggressive. It's going to fluctuate more, but I think you'll be really happy with the results. When you take a look at sales growth, those are the 2 fastest growing industries on the planet. Okay, they're outgrowing everybody. So they should do better. Knock on wood. Okay, you're not allowed to promise any of that stuff. If you and by the way, there's a report that I can put together for you as well. That if you wanted to get an idea of how much income your savings may generate in retirement, I can do that for you. And you don't even have to come in for that. You just call me. We'll have a phone conversation, and I'll send it back to you. I like it. This is a tool from BlackRock. BlackRock is the largest asset manager on the planet, and they're actually bigger than Fidelity and Vanguard. That's how it goes. BlackRock, Fidelity, and Vanguard, top 3. And the report's called My Retire Report. I'm so tired of listening to all these people talk about nonsense that, just to fill up airtime. I know what that's like. I mean, to have to do that, but I really think you should try harder. Get some more important items like how much can I spend without running out of money in retirement? That would help. You never see a headline that's that direct. In fact, this coming up year, that's one of my goals. Just be direct. That's how I like salespeople. A lot of people think salespeople like that are rude. I don't. Tell me what I'm buying. Tell me what I'm up against. Give me the good and the bad, and let me make the decision. Hardly anything's ever gonna be perfect. That almost never happens. But just give me the facts and let me decide. I'll do it. So that's how I am. If you want to figure out what you think your expected income could be in retirement, no problem. That report, by the way, doesn't take me very long. It takes about 10 minutes at the most. If you want to see the report on the semiconductor and healthcare model, no problem. I even have a model that's an alternative to the model. I built a model about 5 years ago that I really like. I use it often. I own it personally. And it was to comply with Department of Labor rules that came out at that time period. And we call it our DOL model. I really like that one too. It's got it's actually more traditional. It's got large, medium, small, international, emerging market. It's got dividend paying stocks. It has momentum stocks in it. Basically, if it's in there, if it's out there, it's in there. It's kind of like that old Ragu commercial. It's in there. But I will provide that for you, whatever you'd like to see, and try to get it back to you as quickly as I possibly can. And so I was going to, let's see here. Yep, I'm going to, hang on a second. Sorry about this. Okay. Just to give an example, somebody that was 65 years old and has $500,000 to invest. The income that they're projecting through BlackRock, through their website anyway, is on the low end $22,000, on the high end $27,000. That's what you could take out, and they figure if you if you're investing your portfolio like in a 60-40 blend, that's approximately what you could take out. Would be, let's see, what is that per thousand? It's about $5,000 a month. A year per 100,000. Now, when you invest that way, it's actually going to fluctuate. It's going to fluctuate a lot, which is one of the reasons that we've also been looking at a product from Nationwide, and it's called a fixed index annuity. And there are other fixed index annuities out there. Actually, there are tons. There are thousands of them, and they've all got different criteria. I just happen to like this one, and the reason I like it is I think they're all super complicated, by the way, but I think this one is one of the easier ones. And you can go to their website. I can send you the link if you want to request it. You can put your age in there when you think you might want to start drawing on your assets, and it'll show you a chart. And I think I put in, this one was somebody who's going to be full retirement age next year, wanted to get some ideas as to what kind of income they could generate. So if they'd put $100,000 in 12 months from now, they'd be able to take out $5,956. Okay, that's almost 6%. That's almost 6%. That's the guaranteed lifetime income. They would pay that out forever. Now, that is actually higher than the BlackRock recommended. The thing that we just talked about. This is how much. So a traditional portfolio, this is how much you should take out. Now, I should tell you also that the traditional portfolio is a little bit lower because over time you're going to be expected to have to increase that. The fixed index products are a flat fixed rate, and no matter what happens in the market, they're going to pay you that until you die. Whatever's left, and by the way, this makes this a lot different than a lot of other annuities. Whatever's left in the investment account goes to your beneficiaries, does not go back to the insurance company. That's kind of a big deal. Another big deal is that they will guarantee that, let's say you started off with $100,000 and you turned the income on. You started taking out $5,900. You did that for, 3 years. So you got nearly $18,000 out of it. The market crashed. If you were in the S&P 500, you'd be down 50%. Maybe your other investments did drop 50%. You had a heart attack and you passed away. Well, the worst case scenario you do in this is that they would take the money that you spent out of the account. They would take a look at the account value. If the account value is higher than what you started with minus what you spent, you're going to get that. You're going to get that account balance. If it's not, if it's lower than whatever you took out minus what you've invested, then they will make that up to you. So let's say you took out $20,000, okay? And the account value is only $60,000 because the markets have done really, really poorly. That one probably wouldn't drop that much. That's a long story. But anyway, if it were below the amount that you started with minus what you took out, they will add to that, and that's what they would pay to your beneficiary. So that's kind of a big deal. And that really helps out for estate planning purposes and all of that kinds of stuff. And by the way, for every year that you're not taking it, the income that you could get will go up. They've got a schedule that they'll guarantee that income will go up by. You can take a look at that online. And it's all tax deferred. So you're not getting 1099s on this stuff. And one of the The only reason, actually, that I'm looking at this is because interest rates are so low. I don't mind a stock portfolio. I think stocks over the next 10, 15, 20 years are probably going to do extremely well. Extremely well. I know they'll beat fixed income because fixed income is near zero, and it's taxable. On top of that, lovely. And when interest rates go up, bond prices have a tendency to go down. So traditional bonds, I mean, unless you got to hold super short-term stuff, the average maturity of the average bond in the portfolios that we're holding is about 16 months. That's the average maturity of the bonds in the portfolios. Are they there because, am I getting a big rate of interest on it? No, not at all. But it keeps my whole portfolio from dropping 50% or more, because that's not going to go down 50%. By the way, it will probably be down 10 at least, but it's not going to be down 50. So, and again, this is one of the reasons I'm talking about the fixed index products, because you know what? They have guarantees. There are guarantees there. There's guarantees on the principal that you can get. There's guarantees on the income that you can get, and you just can't get them anywhere else, at least not right now. Now, that may change. I hope it does. But right now, for the foreseeable future, this is a very, very competitive product, and I think it's a good one. I think it's a really good one. Are you kidding? $5,956. You know what? $100,000 at 1% is $1,000. So yeah, it's hard to find a 1% CD right now, but even if you did, it's $1,000, and it's taxable. Okay, so after you paid your taxes on that, you get what, like $800? So I don't know, $5,956 or $900. You know, I don't think that's a tough comparison if you're looking at it from the standpoint of how much income can I produce. And they have penalties if you go above a certain dollar. I mean, you can take out like 7% a year, no penalty or anything like that. If you get sick, go into a nursing home, they'll waive the penalties on it. The penalties really aren't that bad anyway, when you think about it. If I had to pay the maximum penalty that comes out during the first 2 years of 9%, well, guess what? The stock market's up or down 10% every other month anyway. So I don't even think that is all that bad, But it's amazing how many people are like, oh, I don't want to pay a penalty. I'm like, it's 9%, and that's what it starts out at, and then it goes down each year, and will be less than that. If you really needed the money, just pay the penalty. That's all there is to it. Anyway, I got about a minute before I have to take a real quick commercial break, so I'm going to take this time to plug my website. If you hear anything that you want to talk about, you can always call me at my office. That's 330-664-0700, or you can go to my website, bullingtoncapital.com. There's a contact us page. If you'd like to talk about these things, you don't want me to send you links to websites, you want to request a specific report, I'll probably have to call you just to verify on that one. I just don't want to get in trouble for, putting material out there that my license doesn't cover. So, anyway, I would be more than glad to send you any of the material that you hear about that you have more questions on. I heard that music. That means I got to run. This is Bill Bullington. I'll be back after these messages.
Rocking around the Christmas tree at the Christmas party hop. Mistletoe hung where you can see every couple tries to stop. May peace rise.
And we're back. Hey, before I get to stocks, by the way, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. And if you'd like to get in touch with me, just go to my website, or you can call me 660-07. I'm sorry, it's 330-664-0700. I have so many phone numbers in my head, I'm going crazy. The 330-664-0700, or just go to bullingtoncapital.com. If you've heard anything that you've listened to here that you want more information on, please feel free to reach out to me. I'll get back to you as quickly as I possibly can. And incidentally, so if you wanted to see how far your income could go in retirement, if you're spending in retirement and you want to see what would be recommended by the world's largest asset manager, I've got software there that I can plug in, and it only takes a few minutes and gives you a good idea of how much your income should be or could be. And then if you're above the age of 40, looking to get ready for retirement, there's another piece of software there that we can kind of take a look at what you're doing now, project that out into the future, take your Social Security into account, and give you a pretty decent idea of what you could expect to have during retirement. So those services are free. They're pretty easy, actually. I really like simple. Occam's razor, the simplest solution is often the best. I find that to be true in a lot of stuff, especially when it's related to finance, and particularly personal finance. A lot of this is really complicated, and the complicated stuff most people don't really have to know, but unless you understood it, it would confuse you. So you generally end up learning a lot of the more complicated concepts just so that you know what you don't have to pay attention to. That is what is so rough about this industry. I don't know if you've ever seen a dictionary of financial and accounting terms. They're a couple inches thick. Yeah, almost as bad as that book for beginning tax preparers. But so anyway, let's see what we're going to talk about. So we talked about basically the economy in general, fixed income. We talked about, looked at the situation of somebody with 67. You could put $100,000 in there. You're going to get $5,956 for the rest of your life. When you die, whatever money left goes to your beneficiary, not to the insurance company. They make a promise that you or your family cannot get back less than you've invested. That's a big deal. If you're not taking it, it's tax deferred. People get confused by this, though. They get confused. They think there's a thing called a minimum income benefit value and the guaranteed lifetime income. That benefit value is the number that they use to calculate the income. It's not the cash amount in the account. It's the number that they use to calculate the income that you're going to get. The investments are a separate issue altogether. And I think the guarantees are actually going to be higher than the investments will perform. That's one of the reasons I like this thing so much. So, again, if you have more questions on that, feel free to reach out. I do think that the stock market still provides the best returns in the long run. One of the things that encourages me, so I've been running a certain portion of my money a certain way for an extremely long time period. And sometimes it does a whole lot better than the market, and sometimes it doesn't. That's just kind of the way that works as well. But when you're looking at long-term results, it's pretty good. If you've got thick enough skin, and I'm going to tell you, there are a long time period. I think I have about 35% in cash in that account right now because I just haven't been able to find it. And there are things that I do want to do. I just haven't gotten around to doing them yet because this time of year it's really tough, and it's actually cost me money because some of the stocks have started to move up that I've been eyeballing. So, but anyway, we'll talk about that in detail on future shows. It's all math. If you're going to pick stocks, I think you got to have a fairly decent handle on percentages, and that's really, if you apply it the right way, it's about all you need. I know Warren Buffett's very fond of reading financial statements, learning all that he can know about an industry. He likes to stick to industries he feels like he knows very well. and then he takes it from there. He tries to find companies that have something about them that's going to give them long-term earning power. And whether it's a brand like Coca-Cola or whether it's a process like one of the steel companies that he owns, the symbol is escaping my mind right now. Don't get old, people. But he held on to this company for, I don't know, more than a decade, and it was down a lot. You know, that's see, value investors, I think, are tougher than trend followers. Those are the two basic types. Trend followers, also called momentum investors. Value investors called a lot of things, especially when all their stocks are down. Just kidding. But the value investor goes in, tries to evaluate a business that he thinks is going to grow, or she thinks is going to grow over time, and is selling for less than what they think it's going to sell for someday in the future. And then they have a lot of patience. And that ain't me. I am not patient with individual stocks. So my value stuff that I own is actually in a fund because I know I need that. A lot of those companies don't move nearly as fast in a downward direction. So it gives your account, your portfolio more buoyancy when the market's correcting. Not a ton, but it does help. And it can be really frustrating being a value investor, holding on to something for years before you see a profit in it. And but if your math was good and if your insights were good, that can really pay off. Ask Warren Buffett. I just don't like to do a whole lot of that myself. I used to, but and I still have some. I mean, I do. I still have some of those stocks. I guess it's really hard to break old habits, but I keep them separated. I keep those stocks separated from the other ones in my accounts. And that way I know when I'm looking at one account and the market's up a lot, and it's not, it's probably the value-oriented one. If I look at one and it's up a whole lot, I know that the market's probably up a lot. That's the momentum one. And we're going to talk a little bit about that on the, I was going to talk about it on today's show, but I'm pre-recording the show. And it's running during the day, which is hilarious because no stocks are coming up on the scan because the day's not over yet. But anyway, I just fixed that. I just have to take the volume off of the scan. And like I said, I have spent a ton of money on this. And first quarter this year sometime, we are going to be able to get people together. I can show you what this is. It's called momentum investing or trend following. There are a bunch of names for it. But basically, you're a longer term trader. You're not going to day trade. You're not going to try to compete with multi-billion-dollar high-frequency trading firms. That's idiotic. You know, you cannot compete there. They just have too much money and they're too much faster than you are. But you can hit them in their soft spot. When I was a kid growing up, playing football, a bunch of my coaches used to say, "We're going to hit them where they ain't. We're going to send 3 or 4 guys over this side. We're going to fake the ball going that way, and we're going to give the ball to the guy on the other guy, or throw it back to across the field and hit them where they ain't. Because when they start following us to that side, we're going to trick them." And this is kind of like that. You're trying to think about where they're going to be, not where they are right now. And actually, they've shown signs of going in that direction. In the stock market's language, it would be going up. So if you want to make money relatively soon, shouldn't you buy stocks that are going up? Think about that. Yeah, everybody's heard buy low, sell high. No. Even Peter Lynch said he thought that was dangerous. If you don't know who Peter Lynch is, it's because you're under the age of 50. And Peter Lynch, by the way, if you put $10,000 in his fund, 13 years later when he retired, it was $330,000. That's a lot. No, Warren Buffett didn't do that, by the way. And the amazing thing was he did it with a publicly held mutual fund. And there are so many restrictions on that. That is mind-boggling that he was able to do that. Anyway, so I'm looking at I ran the scan. I took the one of the criteria off of it. And actually, it's pretty interesting. I'll have to run it again later. I'll just go down through real quick. A lot of building companies in the building sector and construction have been coming up on these scans quite often. One Century Aluminum Company. I've probably owned that multiple times over the years because it is and it's really volatile, super volatile. Yeah, but the chart on it looks really good. And this is a visual. You're trying to recognize patterns, and there's a pattern here. William O'Neill would probably call this a cup and a handle, but it's not. The handle is forming below the left side of the cup, which is fine. It actually just crossed above its 30-day average 1 day ago. I'm sorry, the 30-day high 1 day ago. It's up again today, about 3.69. $16 a share. CENX is the symbol of it, and I may take a shot at that one later on today. Let's see, Owen Financial. There's another company, Wabash National Farm and Heavy Construction Equipment. There's a casino, which Bluegrass Vacation Holdings. I'm not sure where they are. Wonder where that is. Anyway, Hillenbrand, not sure. Mosaic, that's the old industrial company. There are a couple of REITs on there. And let's see, Faro. Magna Semiconductor. Now, this one looks good. I'm going to look into this because this one just came up. I haven't seen this on a scan for eons. I mean, it's been on scans before, I don't know, probably 10 years ago. But this one looks pretty good. It ran up to about $28, comes down to about $17, starts channeling sideways, breaks below support. Now it's breaking above resistance. And it's a semiconductor company. Now, I own that semiconductor model. It's got almost every semiconductor stock in the entire country in it. Actually, I think it does. But so I know semiconductors are hot. I know they're doing well. I'm going to go back and look into see what these guys do. But I'm going to buy this one. I'm going to call Gary and have him put this in my portfolio. So this is Thursday, people. So you're going to be listening to this on Christmas Day on Saturday. I may have already been stopped out of it by then. So don't load up on this. But semiconductors have been doing well. The chart pattern looks really good. The price to sales ratio is only 1.3. The industry average is closer to 5. So if you could buy something for $1.60 that normally sells for $5, would you do it? If you could buy a $500,000 house for $160,000, would you do it? Okay, that's my point. And these are the things that coming up this year we're going to be talking about. We're going to be teaching. It doesn't really take a long time to go through these lists and pick stocks if you really have a passion for doing that. So, and I know I've got a lot of listeners that do have that and have been kind of leaning on me to talk more about stocks, which is why I'm spending so much time on it today. Because I'll do 15 minutes per show. 15 minutes is a long time, by the way. Go into your bathroom sometime and talk to yourself for 15 minutes into the mirror. Because that's about what this is like. So, anyway, going on. Let's see. Faro. Interesting. And today, it's going to be pretty slow now, I think, from through the end of the year. And tomorrow it'll probably, either crash or go up 10% in a few days, just because I said that. But let's see. Hyatt Hotels. Oh, it's got a nice looking chart pattern. 3.3 price to sales ratio. Not all that great, especially for that particular industry. Now, here's one. Live Nation Entertainment, LYV. I think this is a venue for entertainers. Okay, and my programmer who just has his own company that goes out and does a lot of entertainment told me it was, what was it again? The okay, cool. So that's pretty cool. It's got a really nice chart pattern. I've seen this thing go all over the place. The price to sales ratio on it's fairly high, but it's if you put 5% in there of your account value and you put a 10% initial stop on it, you're only risking 0.5%. By the way, that's the secret. And you want to keep your risk less than 1%. On that one, it will only be 5% because you put 5% of your portfolio in there. You put a 10% initial stop, and that's a stop loss. That means if it drops 10% from your purchase price, you're going to try to get out of it. So that's roughly about at 0.5%. That's not a lot to risk on a stock. And you got 5% of the money in there. So if it takes off, you're going to do well. If it doesn't take off, you won't get hurt that much. In fact, it's negligible. And that's the real secret, by the way. I just gave away the real secret to being successful and without charging you for it. And you'll pay when you get in there anyway. Not me. It's just the market itself. It takes a toll. It really does. But if you use what I just talked about, of 5% position, 10% initial stop, the maximum number of stocks you'd ever have would be 20. And you can set these stops up to execute automatically, which we will talk about next week as I hear the music. That means my show is over. Thanks for listening, everybody. Everybody have a great holiday season. This is Bill Bullington. I'll be back next Saturday morning. And have a good week. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.